Their primary goal is to provide a large outside profit back to investors. Each of the corporate investors are placing funds based on strategic value to their core business. Changes in staff can happen before, during, and after an investment deal. The value add can range, so make sure you ask these questions before you take on their money. What's the difference between venture capital and corporate venture capital? I could talk at length about this particular topic, having worked with a number of traditional venture funds as well as corporate venture funds. I'm going to do my best to keep this really condensed and relevant to founders, otherwise this video is just going to be too long. Corporate venture capital, as the title implies, is a venture fund that is attached to a company or some sort of organization. For the purposes of this video, I am going to actually include the university funds as well as government funds into the CVC category. The very first crucial difference is ROI. A traditional VC fund typically follows the 2 and 20 rule, i.e. they charge 2% management fee for the amount of money they've invested and a 20% carry or commission from the money they made from the sale of a startup company. Now that's a very general rule. I've seen VC funds charge 0% and then 30% carry, and then I've seen other funds charge something like 5% fee and then a lot less carry. The management fee, i.e. the 2%, is meant to cover the fund's salaries, overheads, any legal fees, accounting fees. Naturally, the smaller funds will have less money to cover the overheads, so sometimes the team is actually part-time. This is also the reason why you don't really see many VC funds under 20 million. The key takeaway here is that the percentage fee they charge yearly to manage the fund is where salaries and overheads are drawn. Now, compared to a CVC, normally salaries, overheads, all the resources and costs are absorbed by the corporate. Again, that might vary a little bit. Sometimes there is a separate entity and a separate fund where the 2 and 20 rule applies for that particular CVC fund. However, again, normally the corporate provides some resources, some offsetting of the overhead costs, if not all of it. Particularly the early corporate funds where there isn't really an investment structure set up. There might not be a separate entity altogether. If the management team are lucky in a CVC, they might get some percentage of carry or commission when there is an investment return. However, that is very unlikely and the percentage would be quite small. The key difference with the CVC is that the team is always paid a reliable salary and the percentage carry is somewhat flexible if it exists at all. The management team of a CVC relies on the salary to provide them the key source of income, as opposed to a traditional VC that is more dependent on that 20% carry and commission on the sale of a startup as their main source of income. As you probably gathered, the corporate entity is the investor and therefore absorbs most of the actual profit from the sale of a company. This is the reason why you normally see a managing director for a CVC as opposed to a managing partner for a traditional VC fund. Whenever you see partner, it means that they make some sort of percentage on the investment return. Number 2, criteria. While a VC fund might be investing under certain themes and sectors, frequently called a thesis, which they believe will provide exceptional returns, their primary goal is to provide a large outside profit back to investors. The important point here is that they are purely profit-based in their decision-making and that each startup must have the potential to return the size of the investment fund. CVC may have investment return as one of their top criteria so that the fund is self-sustaining, but it is normally not the primary reason they are looking for startups. Instead, a CVC's goal for their innovation or venture arm is to provide one or more of the following: R&D, research and development, i.e. they're looking to outsource some or all of their function instead of keeping and funding it in-house. They may or may not be theme-focused, i.e. improving parking or energy usage could be themes for a real estate builder or operator. Or they're looking for acquisitions. So they could be looking to gain a competitive advantage and outsource their innovation function. They might eventually look to acquire the technology, bring it in-house. Being an early investor allows them to look inside, look under the hood before making a purchasing decision. They're looking for value add to their clients, their customers, their members, or their network. For example, an insurance company that has a lot of clients in farming might start investing in ag-tech or agri-tech that improves the quality or quantity of the produce or yields of their farmers. Reputation and brand could be another reason why they're looking to invest in startups, i.e. they want to be seen as innovative and distinguish themselves from their competitors. This is typically linked to a certain theme, i.e. funding clean tech to improve their social image. The main difference here is that CVCs are strategic and looking for ways to advance the corporate and parent entity when investing their time and resources. While a traditional VC fund will also have themes they focus on, they're more influenced by their LPs and providing a large investment return. So you probably gathered that normally with a CVC, there is one corporate entity that funds the majority of that investment. On occasion, they could also be an entity with a number of other collaborative corporates in a pooled fund, i.e. where several complementary businesses make a contribution each into the larger fund. Either way, each of the corporate investors are placing funds based on strategic value to their core business, and making investment return is not the primary goal. Number 3, management team. As I mentioned, the management team of CVCs are typically employees. That means they'll tend to have at least some elements of an employee mentality and a little bit more risk adverse. They'll be subject to operational KPIs and not just investment KPIs. There's also the matter of promotions and changes in staff. You'll find that with CVCs that happens a lot more often, given that they're on a salary and the bulk of their income comes from the salary. So as a result, with a 7 to 10 year exit for a startup, more than likely you will get changes in the management team. If they perform well, then they will more than likely get promoted or move on to a more challenging role. This is something to keep in mind when you're raising funding from a CVC. Changes in staff can happen before, during, and after an investment deal. On the flip side, if the CVC function is managed well and has influence within the corporate, you could gain access to a vast amount of resources, including perhaps to some amazing talent, marketing channels, data, research, customer information, as well as their own R&D. The value add can range, so make sure you ask these questions before you take on their money. Another plus is that they will likely be making investments that are complementary to your technology. So you could end up with a large group of collaboration partners in the form of their portfolio companies. A traditional VC fund may focus on a niche area and so could offer this as well, but frequently it's a little less concentrated than a CVC, given again the key drivers for why they're investing. Number 4, customers. In a sea of startups, having a CVC on your cap table obviously helps to validate your brand and your product in the market. More than likely, they will be a pilot partner or early customer, or perhaps even help you to build and test the MVP. They could also provide access to their network, their customers, their partners, their clients, including investors. However, given that CVCs may be investing in order to gain an edge over their competitors, there might be non-competes attached to their investment. This could relate to not directly selling or retaining investments from their competitors, or could be reputationally related, such as limiting you pivoting to a sector that could negatively impact their brand. A classic example of this that I've seen is with the state government startup fund not allowing you to move your primary location to another state, or pivoting your business to the gambling or adult entertainment industry. The first makes sense given they are trying to increase the number of jobs in their own location, and the last would obviously cause a lot of upset voters using taxpayer dollars to fund these less desirable sectors. Typically, there could be a full withdrawal or heavy penalty for violating these conditions, so ensure you're understanding these clawback clauses or put rights in your investment documents. Number 5, equity. As a corporate isn't investing just for financial return, the ownership stake in the deal is actually less important for them when compared to a VC fund. VC funds typically won't do a deal unless they have anywhere between 5 to 33% equity stake in the startup. While I won't get into the specifics on the numbers of why it's that particular percentage range, they basically just need to own enough to provide a financial return should the company exit. So as a startup or scale up, which one is better for you to raise capital from? Hopefully you've gathered that it really just depends on what you're looking for and the risk you're willing to take. Will it be an issue if the corporate has a change in their management team and you lose connection to the corporate? Is it only the funds you're after or the credibility that comes with being tied to a bigger brand or the name brand of a well-known and successful VC fund that might have deeper pockets for future rounds? These are all really important things to consider, and there's pluses and minuses on both sides. As always, my advice is to ask a lot of questions and vet your investors like you would with any employee. If you're looking to pitch more effectively to VCs and CVCs, you might want to check out my online tools and the course Raising Your First Round of Funding. Next up, check out this playlist of investor reviews where I do a walkthrough of how founders have done things right and wrong.